Where are interest rates headed? Well, they're going down, and we kind of all should know that hypothetically. But rates are projected to continue to be cut. We expect the Fed to start cutting rates over the next 6 to 8 months. So as we get closer to the end of 2024 into 2025, rates are going to continue to go down. Here's the forecast from some pretty big players, the Mortgage Bankers Association. They're projecting that in Q2, which we're in now, 2024, the 30-year fixed average rate is going to be 6.6%. By Q4, we're down to 6.1. And they're kind of on the lower end of the spectrum. By the end of 2025, down to 5.5%. I will tell you guys right now, once you get back into the fives, cash flow starts getting really serious. Properties can start cash flowing $1,000 a month again in places like Philadelphia. And I'm going to talk about where to invest in Philly in just a second. If you guys are interested in Philly. Philly is an interesting market because it's a top 10 cash flow city in the country. It's the 6th largest city in the country, and it's the sister city to New York City. So as people get priced out of New York, which is guaranteed to happen, they're going to keep moving to Philly because people in New York hate Boston. They ain't moving to Boston, then another close big city, because New Yorkers hate Boston, if you didn't know that. So rates are going to go down. As rates go down and get closer to that 5% range, or even a low sixes, right now they're less than 7. So they're already trending down. They were as high as 8% earlier this year. Now they're already down a point and under 7s. What's going to happen is there's a lot of pent up seller demand. There are a lot of sellers that are sitting on their properties. They won't sell until rates go lower. But if rates go from 6.9 down to 5.9, 1 percentage point, which could happen this year, it's going to start unlocking that seller demand. Sellers are going to start dumping more properties, but also buyers who are sitting there trying to time interest rates, they're going to come back in droves. 1 percentage point, everybody's going to start buying again. People are going to start selling again. People are going to start buying again in a massive way, and prices are going to go up. So the further rates go down, the higher prices are going to go, which means there's a window of opportunity for you right now. There's a very limited window of opportunity for you to buy properties while prices are pretty flat, and they've been flat for about 1.5 years now. And then as prices rise and rates go down, you can refinance into a lower rate and unlock cash flow. This is a unique window that those who are smart enough, who are bold enough, brave enough, will take advantage of. They say when there's blood in the streets, buy the real estate. What that means is when people are fearful, when people are scared of the market, when people think it's a bad market, that's when you should be looking at buying opportunities and opportunities to exploit the market situations and conditions. This is the play, which is to buy. The best cash flow play right now is to buy properties at an extreme discount, which you can do right now. Understanding that rates are higher, put those deals not on a 30-year fix. Do not go with a 30-year fixed note right now. I'm going to say it. Nobody else is going to tell you this. But the 30-year fix, when you get that note, you're paying a higher fee for a 30-year lock-in at a low rate. You're paying a higher fee for that. So there are higher fees embedded in that loan. There are higher origination fees. There's a higher interest rate that you're going to pay today. And there's usually prepayment penalties that are tiered down over the first 5 years on these 30-year fixed notes. What you should be doing instead is getting a lower rate, getting a 5-year one. It's called a 5-1 ARM. It's locked in for 5 years, and then it's an annual renewable mortgage after year 5. A 5-1 ARM comes at typically a 1 percentage point lower interest rate, or thereabout, 0.5 point to 1 point lower, but as much as 1 point lower. So if the average rate on a 30-year right now is 6.9, you can get some 5-1 ARMs in the high 5% range or the low 2% range without any rate buy downs or any extra add-ons like that. Since you're going to refinance anyway as rates fall, this becomes the smartest strategy today. If rates are going to go down in the next 2 years, why would you lock in a 30-year fixed at a higher rate when rates are going down and then pay a penalty to refinance out of that into a lower rate? Just get the lower cost mortgage option with a lower interest rate associated with it and refinance out of that. That 5-1 ARM is also going to have a reduced prepayment penalty, if not no prepayment penalty at all. The reason why mortgage companies are not advertising this to you is because they know it's the best strategy and they want you to pay more fees. Typically, why would that hurt them if you pay more fees? So they're not going to tell you the best strategy. They know you're going to refinance as rates go lower. They're just waiting for people to want to refinance and get beat over the head with those fees. I don't want you guys to get clubbed over the head like that. So rewind this, watch this over, and pay attention to that strategy.